Welcome to the Deep Dive. Today we're looking at Distribution Solutions Group, DSGR, and their Q2 2025 earnings call.
Right.
And it's not just about the numbers. We're really asking, can this consolidate and integrate strategy they're pushing so hard actually create a truly resilient, high-margin business?
Yeah, or are those integration headwinds, the costs and complexities, just too much in the near term? It's a critical question.
Exactly. So we'll unpack the key figures, their strategic moves, and try to read the tea leaves on management's tone, all to help you, the experienced investor, kind of weigh that balance.
And DSGR certainly gave us a lot to talk about in Q2. They really got the market's attention.
They did, starting with the top line.
Yeah. I mean, they didn't just meet expectations. They pretty much crushed them.
Yeah.
Pulled in $502.4 million in revenue.
Wow.
Which is solid 14.3% increase year over year. And even organic average daily sales were up, 3.3%?
That's significant growth. And it wasn't just revenue, right? The profit side looked pretty compelling, too.
Definitely. Adjusted EPS came in at $0.35.
Which was way above the street's consensus, wasn't it? Like $0.21.
Handily beat it, yeah. Now, GAAP EPS was lower, $0.11, but those adjusted numbers, they really point to some underlying operational strength.
Right, filtering out some noise there. And adjusted EBITDA
hit $48.6 million. That translates to a 9.7% margin.
Okay, nearly 10%. And what really jumped out at me was that margin expanding sequentially.
Across all the operating units, that's key.
Yeah, that is key. Lawson, Gexpro, TestEquity, Canada, all up from Q1.
That sequential step up is a powerful signal, especially with all the M&A activity. And they generated strong cash flow, too.
How much?
$33.3 million from operations, which, gives them that internal funding and flexibility, crucial for their strategy.
Absolutely. So how did the market react to all this? It seemed a bit mixed.
It was a bit of a dance, yeah. Shares rallied initially, up 3.9% intraday on the call day. Suggests investors like the beat, like the cash.
But then
it cooled off a bit, pulled back 3.5% the next day.
So appreciation for the strength, but maybe some caution about the integration story, the costs involved.
That seems likely. Balancing that top-line strength against maybe some of the near-term pressures and the execution risk involved in integrating all these pieces.
Okay, let's dig into that balance then. This consolidate and integrate approach is front and center for DSGR.
No question.
They've spent, around $450 million in cash since that April 2022 merger.
Across 9 businesses, yeah. And 5 of those acquisitions were just in 2024.
And those 5 alone added nearly $49 million in incremental sales in Q2.
Right. But for you, the investor, the big question is, are these deals really adding value beyond just the revenue number? Is there real synergy, or is it just getting bigger?
Or potentially integration and indigestion, right?
Yeah.
Especially with all the macro stuff happening.
That's the core issue. Management keeps talking about building structurally higher margin businesses over time. It's about disciplined cash deployment, not just buying anything.
So they're being selective, picking targets that add specific capabilities or get them into better niches.
That seems to be the idea. Enhance the core, expand strategically. That's how you make the whole thing more profitable and more resilient in the long run.
Okay, let's talk margins again, because that sequential expansion story was a real standout for me.
It was impressive.
Lawson went from 11.9% to 12.6%. Gexpro Services, 12.6%, up to 13.4%. TestEquity ticked up slightly, 6.8% to 6.9%. And even the Canada branch division improved, 5.2% to 6.5%.
Yeah.
How are they managing that with all the integration going on?
Well, it shows the underlying businesses are performing.
Yeah.
But, and this is important, you have to look at the consolidated picture, too.
Okay.
The acquisition of Source Atlantic in 2024, that actually put a bit of downward pressure on the overall consolidated margin, about 60 basis points.
Oh, okay. So the new piece brought the average down slightly.
Exactly. And management said it wasn't really about Source Atlantic underperforming internally, but more about the regional economy in Eastern Canada.
Right. Economic anxieties, tariff uncertainty up there.
Yeah. And they actually made a point of saying many of the profitability enhancements they're working on, quote, are not yet flowing through the P&L.
Implying there's more upside to come as things mature.
That's the suggestion.
Yeah.
So underlying strength is there, but new deals always bring some near-term drag, requires careful handling.
Makes sense. And speaking of Canada, they highlighted the sort of tale of 2 Canadas.
Yeah, that was interesting.
Bolt Supply out west doing great, nearly 16% EBITDA margins. Double digits.
Very strong.
But then Source Atlantic in the east facing real headwinds. Manufacturing decline, lower MRO spending.
Right. MRO maintenance, repair, and operations. That stuff is vital for factories, but it's often one of the first things companies pull back on when the economy gets shaky.
So it's like managing two completely different situations within one division. How does that affect them? Requires a lot of agility, I imagine.
It absolutely demands it. But what's quite remarkable, despite those macro issues hitting Source Atlantic,
Yeah.
its gross margin has actually improved by 290 basis points since they bought it.
Really, since the acquisition.
Yeah. And they've already done 2 of the 4 planned branch consolidations.
Okay, so they're not just waiting it out. They're actively integrating, cutting costs, trying to unlock value, even with a tough backdrop.
Precisely. That's the kind of active management you want to see to make these deals pay off long term.
That focus is key. Okay, let's shift gears to Lawson, their big Salesforce transformation. How's that progressing?
It seems to be making real, tangible progress. CRM adoption's over 70% now.
Okay.
And they've got a revamped web platform that's getting like 10,000 customer visits a day.
And they've been hiring reps too, right?
Yeah. Added about 90 sales reps in the last year or so. Now, getting those new reps fully productive, that's still a work in progress, as you'd expect.
Sure, it takes time.
But management flags something they see as really significant.
What's that?
Lawson's base business has finally started growing.
Oh, okay. So not just relying on the big strategic accounts anymore.
Exactly. For years, most of the growth came from those larger accounts. Now it seems the broader efforts are starting to lift the core business too. That's a big shift.
And what's the long-term ambition for Lawson's margins?
Pretty ambitious. They're aiming for mid to high teens, maybe even over 20% adjusted EBITDA margins down the road.
Wow. Okay. So they see a lot of potential leverage from this transformation.
Definitely. Moving into a whole different profitability category.
All right. Then there's TestEquity. Big news there with a new CEO, Barry Litwin, starting mid-July.
Right. Experienced guy.
And his mandate seems pretty clear. Ramp up commercial growth, push the digital side harder.
Yeah, and specifically focus on the higher margin stuff.
Like what?
Things like used equipment sales, rentals, calibration services, and those specialty VMI offerings.
VMI, vendor-managed inventory.
Exactly. Where DSGR basically takes over managing critical parts inventory for a client. It makes the customer relationship stickier and generates high-margin service fees.
And those services have much better margins.
Well, yeah, they mentioned contribution margins in the 20–40%, even plus, range for some of those. Huge potential compared to just distributing new products.
So the goal is to shift the mix towards those richer services. What's the overall target for TestEquity's margin?
Long term, they're aiming for double-digit EBITDA margins for the segment.
Okay. Still some way to go from the current, 6.9%.
There is. And it's worth remembering,
It's 13.4% now. That's more than double.
It's a fantastic story of execution. It wasn't luck. It was strategic acquisitions that complemented what they had, plus serious investment in their commercial capabilities. They built a much stronger engine there.
So sustainable improvement, not just a cyclical bump.
Management seems confident. They acknowledge sales comparisons get tougher in the second half of 2025, but they sounded really enthusiastic about their market position and momentum.
Okay, so pulling all this together, the M&A, the margin efforts, the leadership changes, what does it mean for their balance sheet and capital? How are they positioned?
Pretty solid, actually.
Yeah.
They ended Q2 with robust liquidity, $314.4 million, and importantly, nothing drawn on their main revolving credit facility.
Gives them flexibility. And the debt level, net debt leverage.
Stands at 3.5 times adjusted EBITDA.
Is 3.5x comfortable for a company doing this much M&A? Does it leave room for more deals?
Generally, yes. For a company like DSGR in this active M&A phase, 3.5x is usually seen as manageable, especially given their strong cash generation. It suggests they still have, ample dry powder for more bolt-ons without getting over-leveraged.
And they're returning cash to shareholders too.
They are. Bought back $8.8 million in shares in Q2. That's $20 million year to date.
Is the buyback program ongoing?
Yep, still $6 million left on the current authorization. So it shows discipline investing in growth via M&A, but also returning value directly.
And you mentioned cash flow conversion?
About 90% free cash flow conversion, they said, and an 11% return on invested capital over the last 12 months. So the financial footing looks pretty sound.
Okay, let's zoom out to the macro picture. Management's outlook was cautiously optimistic for the rest of 2025.
Right. Acknowledging uncertainties, but still positive.
Particularly interesting was how they framed the trade policy situation, tariffs. Shifting supply chains, they see it as a commercial lever. What do they mean by that?
This is a really interesting angle. Instead of just seeing tariffs and trade friction as a headwind, They think their setup actually gives them an advantage
How so?
because they have a diversified supply chain, deep relationships with lots of vendors globally. When trade policy shifts or there are disruptions,
They can help customers navigate it, find alternatives.
exactly. They can offer sourcing options, help customers sidestep issues in a way smaller competitors maybe can't. It makes DSGR a more valuable partner, potentially increases stickiness, maybe even gives them some pricing power.
So turning volatility into a competitive advantage.
That's the idea, creating a moat in a fragmented market. And it helps that only about 6% of their purchases come directly from China, where some of the biggest tariff noise is. Gives them flexibility.
Smart way to position it. Okay, so wrapping up the key takeaways for investors, DSGR's Q2 looks like a company firing on multiple cylinders.
Definitely executing that dual strategy. Buying growth through M&A, but also grinding out operational improvements internally.
And the market reaction, that initial pop followed by a fade, suggests investors see the revenue strength, see the cash flow.
Right.
But they're carefully watching the integration costs and the near-term margin impacts from those newer acquisitions like Source Atlantic.
Exactly. It's that classic show me story. The potential is clear, but execution is paramount.
But that sequential margin expansion across all the divisions, even with those headwinds, that's a strong proof point for management's ability to operate well.
It absolutely is. And putting a leader like Barry Litwin into TestEquity with a clear mandate, plus those ambitious targets for Lawson, it signals a real focus on unlocking more value, especially through digital transformation.
And the overall sector backdrop, industrials, seems reasonably supportive.
Yeah, the XLI ETF showing mid-single-digit growth lately. So if DSGR can keep delivering on margin expansion and prove out the synergies from these deals,
It could lead to a re-rating, better valuation multiples.
that's the potential catalyst investors will be looking for. Consistent execution is key.
So, for anyone following closely, keep an eye on those upcoming investor events conferences, the roadshow this fall.
Yeah, that's where you'll get updates on how the Source Atlantic integration is really going and maybe hints about future M&A plans. That focus on building structurally higher margin businesses is the long-term narrative to track.
All right, let's pivot to our outrageous but plausible trade ideas segment.
Always fun.
Given DSGR's aggressive M&A, that cautiously optimistic tone, and this whole commercial lever angle with trade policy,
Okay.
here's the pitch. A deep out-of-the-money call option spread on DSGR. Think 18 months out expiration.
Going long-term.
Exactly. Targeting a strike price significantly higher than today, predicated on them announcing another major acquisition, but not just any acquisition.
Needs to be specific.
Yeah, something immediately accretive in an industrial vertical they're not heavily in yet, but one known for high margins. Think specialized components, maybe advanced automation services. Something the market isn't fully pricing in.
So you're betting on a surprise catalyst combined with existing momentum.
Kind of. The idea is the synergy capture they're already working on, plus Litwin boosting TestEquity's digital game, plus that trade policy advantage. All that creates a foundation.
Right.
Then this well-chosen high-margin acquisition lands, and suddenly you get this compounding effect, a re-rating that sends those cheap, out-of-the-money calls soaring.
Betting on them expanding their global supply chain into a lucrative niche the street hasn't modeled yet. Buying the optimism, selling the caution, as you said.
That's the angle. Leverage the underlying improvements and bet on a strategic M&A kicker.
Okay, intriguing. But as always,
Yes, let's be very clear. The trade idea we just discussed is purely for illustrative and entertainment purposes.
it is absolutely not financial advice. Please, always do your own research and due diligence before making any investment decisions.
Definitely. Okay, so to quickly recap our main points on DSGR's Q2.
Strong quarter overall. Revenue beat handily, and importantly, sequential margin expansion across all segments.
Yeah, despite some of those acquisition-related pressures, particularly from Source Atlantic in Canada, weighing on the consolidated number a bit.
Management, sounding cautiously optimistic, clearly focused on integrating what they've bought, looking for more strategic M&A, and using those operational initiatives like the Lawson transformation and the TestEquity push to drive value.
And while the market's reaction was a little hesitant after the initial pop, suggesting maybe a wait-and-see approach.
The underlying improvements operationally and the leadership changes, they do present some compelling potential catalysts for the long term.
Agreed.
So as we wrap up, maybe here's something to chew on. This idea of DSGR turning trade policy shifts into a commercial lever. It's more than just a tactic, right?
Wait, go on.
Could this strategy, using their scale, sourcing expertise, and vendor relationships to navigate global volatility for customers, fundamentally change how we think about competitive advantage for industrial distributors.
Meaning making them potentially more resilient, more valuable than the traditional distribution models, especially in today's choppy global economy.
Exactly. Is this a new kind of moat they're building?
Yeah.
That's something really worth considering as you watch DSGR execute their strategy going forward.
A fascinating thought to end on. We really appreciate you tuning in to the deep dive today. As always, we welcome your feedback and questions.